I think that, if we're looking at these companies, like investors seem to be really focused on businesses with growth right now. And the valuations and the prices that they're willing to pay are not that important to some of them. And a good example that I can see is a company like Tesla. And just so people know, like I don't dislike the business of Tesla at all, and I hope that you know, for the world's sake, that electric cars do become more prevalent. Um, but Tesla's valuation right now, as of today, is somewhere around $250 billion. The biggest car company in the world by market cap, and they make about 100,000 cars. They made about 100,000 cars in the last 3 months. Toyota, who they supplanted as the biggest car maker, made about 2.7 million cars in the last 3 months. So, you know, Tesla is a good story, and it may well grow into a company that deserves a market cap like Toyota's, but they are not there yet. And so a lot of the valuation in the stock price is based on speculation and not real economics. So it's stuff like that that makes me a little bit nervous about where we're at in the markets.
And I know you mentioned just we've talked a lot about Tesla in the office here, and it's trading at 8 times their annual revenues, and they've only had minimal profits to date. And so I know we've talked a lot about how that makes it difficult to essentially value the company. And you mentioned it's not that you necessarily dislike the business, but the ability to come up with what you think that business should be worth today and what we'd be willing to put clients' money into is just for you at this point. It's too, I guess, gets into the too difficult pile.
It gets into the too difficult pile. I certainly wouldn't invest in it at the current price. I wouldn't short it either because I don't want to bet against it. But I think with Tesla, it's really a perfect storm of sort of speculative factors. You have a lot of growth. There's a lot of technology in it, which is a very popular thing right now, is investing in technology. That the Tesla itself is driven by the cult of Elon Musk, and Elon Musk is a celebrity CEO. I mean, he's hanging out with Kanye West and tweeting about it, and he has a rocket company. So like he's basically like Iron Man in real life. And on top of that, Tesla's cars are cool. Like they're fun to drive, and they're just cool. So you really have all these factors working together as positive impacts on the stock price. And when you throw all that in there, people kind of lose sight of what the valuation should be, and they don't really care what the price is. They just see that it's going up, and I think that's what's happened with Tesla. There may be a point where Tesla can get to a profitability level that justifies where their current value is, but they're a long way from that, in my opinion.
So if they disappoint, obviously shareholders buying in today at today's prices may be looking at some time before they get that money back. But I'm sure some investors may wonder why we're why we aren't jumping at an opportunity to own a company whose stock has had such terrific performance. And I know we're comfortable kind of watching from the sidelines. Maybe you could break down for clients and prospective clients what exactly our concerns are when we're making the decision to put clients' money to work and invest their money. Craig, maybe you could just share a little more around our process there and exactly kind of why a company like Tesla essentially gets disqualified from investment opportunities.
Yeah, for sure. So we always start with the premise that our number one goal is we don't want to lose money. And the way that we prevent losing money is we want to build in a margin of safety in any investment that we take. So what that means is there's a margin of error that we can have in our forecast for that company, that we can be really wrong or significantly off on our forecast and we'll still make money. And the way that we do it is by paying less than what we think it's worth. So, for a company, let's say I think it's worth $100 a share. Well, if I'm only paying $50 a share, I can be really wrong on what the actual value is, because it could. Let's say I'm wrong and it's only worth $75 a share. Well, if I had paid 100, I'm now losing money big time. But because I only paid 50, I've still made money, even though it was significantly worse than what I thought it was. So with Tesla, as an example, Tesla's trading at about 8 times of their revenues, which is an extremely high price to pay for something. And so there's no margin of safety to be had there. Like Tesla may, meet all of their objectives and meet all of their goals and justify their current price, but pretty much everything has to go right for that to happen. If one thing goes wrong, the current price doesn't make sense, and people are going to lose money if they're buying it at the current price. So we don't like those types of situations. We like situations where it can go significantly worse than we think it will, and we'll still make money. And that's just not the case with Tesla.